For a director shareholder of a small limited company, the number one strategy for getting profits out of their company should be the payment of a minimum salary. This really is a win-win-win situation for them, and the opportunity to take advantage of this should not be missed. Win number one: every taxpayer has a personal allowance. On the assumption that this is not used up elsewhere, it will be available to cover the salary. Thus, the payment of a salary that is below the level of the available allowances will be free of tax in the hands of the director. Win number two: as long as you pay a salary which is above the lower earnings limit for national insurance, and you process this salary through a Paye scheme, then the director will get a complete state pension contribution. This will contribute towards his entitlement to state pension. As long as the salary that is paid is less than the primary threshold, then this will cost nothing in national insurance contributions. In the absence of doing this, the director would have to pay a considerable amount for Class 3 contributions in order to fill the deficit in his pension record. Win number three: any payment of salary that is made to a director will reduce the corporation tax liability of the company by the amount that is paid multiplied by the prevailing corporation tax rate. Thus, while costing the director nothing in tax personally, the salary that is paid will reduce the company's corporation tax bill. Look out for our next video, in which we will consider how much salary the director ought to take. The payment of salaries is just one part of the overall strategy that we discuss with our clients in order to minimise their tax liabilities. This changes year on year, and thus there is a need for us to continuously keep discussing this matter with them. If you would like to have a free, non-committal meeting to discuss how to minimise your tax bill, please contact us on 01226 245824. We would love to discuss this matter with you.